Hello and welcome to Crux Investor. We spoke earlier today to Niël Pretorius, who's the CEO of DRDGOLD. They're listed on the JSE. They're a tailings company producing gold and a lot of it. We caught up with them last December and they have gone up 6 times since we spoke to them. One of our best recommendations of last year. We speak to him at length, and if you want to hear what my feedback, thoughts and opinions are on that, you can get that at cruxinvestor.com/club, where you can also get company reports, training modules, commentary from market experts from all around the world, summaries of other interviews that we've done, and of course there's a thriving community of investors who are sharing their thoughts and ideas. And if you go now, there's a 1-week trial. And of course we'd love to hear what you think, so do click the like button and leave your comments below, and you can look in the description for some of the topics that we discussed. And if you could click the subscription button, it'd be much appreciated. And of course for more videos like this one, click the notification bell. Niël, how are you doing, sir?
Hi, good day. I'm doing really well, thanks. And yourself?
Not too bad, not too bad. I spoke to you back in December. Different world, different company, actually. So we've got lots to catch up on for sure. How have you been? How is South Africa?
Oh, I think South Africa is doing a bit of a damage assessment. Our economy is obviously come under enormous pressure because of the lockdown, tourism in particular. But we're slowly but surely emerging. I think the impact of COVID on the health of society generally has not been as profound. And there are a number of different theories for that. But I think South Africans generally, they're picking themselves up and trying to go back to some sort of a new sense of normality.
Yeah, because I mean, you guys have taken a little bit of money, or the country has had to take a little bit of money in from outside, from the World Bank, etc., to kind of cope. But you seem to be saying, health-wise, there's no new secondary spikes, or no. It's not affecting your ability to do business.
We're in level 1 lockdown, which means that a lot of the former restrictions have been relaxed. So there's still restrictions on the number of people who can assemble, etc., etc. But in terms of tourism, which is big in South Africa, hospitality, the restaurant industry and so forth, those are slowly but surely re-emerging. There's still a number of restrictions on, I'm happy to be in the winelands at the moment, and still restrictions on the sale of liquor over weekends, etc., which still impact this kind of economy quite significantly. But on the whole, I think there's light at the end of the tunnel, and we're slowly but surely getting back into business. The impact's been huge, though. I mean, it's going to be years for this to recover. There's no doubt about that.
Yeah, it's always good to kind of sort of understand how different countries are reacting and behaving. Hopefully you guys get back into some semblance of normality soon. But look, for people new to this story, we spoke in December, great run through of your business model, but we've got a bunch of new people on here. So can you give us a 1-minute overview of the business, and I'll pick it up from there?
Yes, certainly. So DRD has been around for as long as the gold industry has been around in South Africa. It started out in the 1890s as a deep level underground mine, but it's since evolved completely into surface reclamation. So we recycle gold tailings in and around the Johannesburg area, and now more recently also in the more westerly part of gold production in South Africa, in the Carletonville area, around the Kloof and Driefontein. Our company is owned 50.1% by Sibanye-Stillwater, following a transaction to acquire some additional assets. And then for the rest, it's freely held through a listing in Johannesburg, and also on the New York Stock Exchange.
Okay, fantastic. Like I said to people, people should go, and we'll put a link below to the conversation we had in December, because I think the business plan is really solid. You were very clear and articulate about how you're going to go about delivering that. So today I just want to focus on, what have you done since we last spoke? Now, obviously COVID's come, but for gold companies, that's been great. Gold price has been great. Your numbers look great. But I want to talk about the future and what the future holds. So you had a couple of projects. You've got Ergo, and then you've got Far West. Can we deal with Ergo and where you're at with that? Because when we last spoke, you've had that for a while. You need to work out how you sort of extend that and how much capex is going to require to be able to extend that. So you can give us an update on where you are with that project.
Certainly. So Ergo is the mothership of the organization. It's made up of 2 plants. The one is a lower volume, higher grade plant, and then the other one is a much larger close to 2 million ton of a lower grade plant. It produces material, or it recycles material from around about 7 sites, give or take. So this is slimes and sand that gets pumped to the different plants. There it gets recycled and then deposited onto a large tailings deposition facility. That deposition facility is to be increased in size in order to extend the life of Ergo and for it to maintain its current production run rate over time. So it's an ultra high volume setup with a nano extraction efficiency. We recover about 200 parts per billion of the material that gets put through this plant. Our waste operations, that's the one that we acquired from Sibanye Stillwater, or that brought us into the Sibanye Stillwater group. Much lower volume, about 500,000 tons a month. That's the first phase. Over the next 3 years, that's going to be upscaled to also north of a million tons a month. That requires an additional tailings deposition facility. And then it too will have a life of roughly 18, potentially 23 years. Tailings facility that we're building there is large enough for a regional consolidation of tailings. And that's really for the next generation of management to at least have something that was built in such a way that it can play a similar role to what we saw at Ergo, where it is big enough for a consolidation beyond the current resource, or what the resources were 10 years ago when the business was started.
Okay, not everyone understands tailings. They understand mining, but tailings is something which makes them nervous. They don't quite understand, so therefore they don't invest. You're about 6 times larger than when we last spoke, so obviously something's gone right. It's worth just explaining to people. I mean, I always say tailings is mining without the risk because everything's at surface. So it's a process-driven organization that can monetize stuff ore sitting at surface. So can you just sort of explain a little bit more detail about how your process works? I know you touched upon it there, but perhaps give us a bit more of a clue about what's unique about you.
Certainly. So I don't think anybody else moves more tons per employee than what we do. So what the features, the things that differentiate our business in the mining environment are mechanization, technology, automation. The setup of this plant being a macro volume environment with almost nano extraction efficiency requirements mean that we need to set up this thing in such a way that it needs very little intervention, human intervention. So our focus, or our approach in terms of technology, is that the human element is still the dominant part of this human and machine interface. So we place smart technology at the disposal of smart individuals. So that's the whole model, but it's extensively automated. It's technology driven. We collect data from 40,000 different data collection points at the Ergo plant, and this information is analyzed on an ongoing basis. So you could literally follow every key dynamic that can impact the efficiency of this plant on a 24/7 basis. And that gets analyzed on a daily basis. So that's the sort of thing that enables one to maintain production even when you have these interruptions or disruptions associated with the pandemic, because it's not a labor-intensive environment. Social distancing is sort of, this is our reality. People do not work in close proximity to one another. A lot of the stuff that happens is done with remote-controlled, automated devices, etc., etc. So that's helped us a lot, and that's one of the reasons why COVID for us it hasn't been quite been that disruptive. We did interrupt operations for about a 10-day period when the lockdown started here in South Africa, but that was really just to make absolutely sure that the changes in behavior that were required to enforce proper social distancing and to ensure that everybody's been adequately counseled in terms of using sanitizer, etc., that those were fully in place. And also to not have to use public transport. We consider that to be a major risk, is for employees to have to get into public transport to come to work and go back again. So the commutes evolved, and that's now all done with public transport, with private transportation, with company provided transportation. So we had about a 10-day disruption, and then we incrementally started going back into the workplace. And some of the sites we were up and running very quickly. Others we had to take a slightly more systematic approach. If you were to look at our numbers, though, and we released those a few weeks ago, you can see that the reduction in tonnage and in production, that graph, which obviously is lopsided towards the negative, was offset and positively offset, in fact, by increases in gold prices as a consequence of global reaction to the lockdown and to COVID. So it was, in terms of financial performance, it was an incredible period for us. We've seen margins we've never seen before, and with a business that sort of geared for this sort of environment that was able to overcome most of the challenges associated with it. And we're very proud of how our personnel responded to the whole pandemic. Out of just more than 3,000 employees, we've had fewer than 50 patients, positive diagnosis, and nobody's passed away as a consequence of that. At the moment, now with the lockdown level way down to lockdown level 1, we only have 2 positive cases that haven't fully recovered. So I think key to the whole thing was the response of our personnel to what was required.
Yeah, so I mean, obviously, COVID's had an impact on lots of companies, lots of producers around the world, and they've all handled it in different ways as much as they can. The stuff you're in control of and the stuff that you're not in control of. I'm interested in the bits that you are in control of. As you say, your production, you're only offline for 10 days, and maybe there was a slow ramp up. But as you say, the volume, yields, and production numbers are down for second half. But because of the price of gold, you've ended the year sort of all-time high numbers, I guess, there in the sense of the margins that you're making, certainly the numbers that we're looking at. So it's all good news for shareholders. You've just out your third dividend for the 13th year in a row, and I think you upscaled it as well. So that's all good news. But you talked about having multiple data points and removing human intervention, where you can to improve efficiencies. But if I look at Ergo, you've had that for 10 years, right? You told me before, you've probably got another 8 years worth there and more if you decide to choose to spend more money on the CapEx. You kind of have to re-engineer that to some degree because it'll be lower grade. So what is that data telling you now? Has anything changed in the last year since we spoke?
Not really, no. The data collection or the way in which we manage information has not so much improved the efficiency as it's allowing us or enabling us to keep the plant in a stable state. So you have fewer disruptions, fewer changes or fluctuations in performance, in plant performance. So look, obviously, because the way that information has been looked at, you don't really have a reporting sort of climate. The conversations taking place at our operations are analytical, because you're not looking for, are we within range? You're in range because that information is freely available to everybody. What the conversation typically looks like is, so what are these numbers telling us? And how can we get it slightly narrower? How can we make this range even tighter? And what is the impact, let's say, of this dynamic? Have we fully considered the impact of this dynamic and some of the other dynamics? In fact, the next step for us now is to go into big data analysis. What we're doing at the moment is we're maintaining the relationship and the interaction, the interface between line of sight dynamics, 7 or 8 dynamics within the plant itself. But big data could tell us how something that's happened in one of the remote corners of the operation, how that is finding its way and amplifying certain responses over a period of a month, 2, 3, 4 months. And then we think that that's going to be an exciting new step for us, and just analyzing the data and setting the plants up accordingly. If you multiply everything by 2 million, then the tiniest of changes could have a very significant impact on the actual performance of the business. But having said that, those changes are small, they're incremental, and they're informed by analytical conversations as opposed to your typical command and report type of conversation that you would have in a mining environment. The way forward for us, because of the quality of the data, gives us a pretty good idea of what sort of balance needs to maintain in terms of throughput rate. In other words, the time spent in the plant and the volume throughput. It gives us a very good idea as to how we should balance the availability of water and where the key risks are in terms of costs. A big step for us over the next foreseeable future, and we're talking now, is dealing with the risk of quality of electricity supply, and also cost uncertainty around electricity supply. Obviously, if the electricity supplier were to fold in South Africa, then it takes the entire economy with it. So that is a very real risk to the Eskom and South African economy and our existence. Those things are linked. But that doesn't mean that you cannot do something about the immediate risks posed by the quality of electricity supply and the costs associated with that. So we're taking the view of, or the approach of setting up a hybrid type arrangement where there's both power storage as well as power generation by way of solar panels. Power storage simply means that you're setting up very significant, and these are modular in design, battery storage capacity. These then get charged during off-peak periods, and also by the sun eventually when the solar farms in place. And what that then does is, on the one hand, it acts as a shield against your peak power tariff. So if you charge them during off-peak and you draw from those batteries during peak, then it means that you avoid, by and large, the high tariff of the peak period of the day, and those are significantly higher tariffs. So you basically justify the entire project, the capex on that basis. But then it also smooths the delivery of power. If you're as instrumented, so to speak, as we are, these are sensitive devices. The spikes and the surges and the drops in power supply, that was the quality of power delivery. These things are bad for your instrumentation. So if it goes through this bank of batteries first, then it means that you have smooth delivery. It also acts as a power backup if there's a sudden drop in power. Our arrangement with the power utilities is that we don't get load shedding. So when load shedding happens, we just need to reduce the amount of power that we use by 10% or 15 or 20%, and we can do that by just switching certain components on and off. But sometimes there's still the accidental either switching off, or there's just a power interruption. So the power bank would shield us against that as well. So that's the near-term approach in terms of power delivery. And because of the quality of the information, we know what the impact's going to be. We know how long we need to be around in order to justify this. We can present value it and know whether it's worth our while, et cetera, et cetera. And I think systematically, that this is the way that we can look at every aspect of the business. We break down the economics of our throughput, notwithstanding the fact that it's in excess of 2 million tons a month. We break it down to on a per ton basis. The extraction per ton, cost per ton, the revenue per ton, everything we do is looked at in that way. Now, of course, if you look at the numbers over the last year or so, 768,000 a kilo was the average for the year up until June, and we report record numbers. The gold price is now sort of stuck just north of R1 million per kilo, whilst the costs are still hovering around R100. There aren't these. There haven't been any significant impacts on cost, because such a large percentage of our costs are fixed in any event. So you do the numbers, and you can see how on a per ton basis, these margins have opened up and stayed open as a consequence of what's been happening in the gold price environment, but also relative to our ability to respond to the impact of COVID.
I appreciate that. I mean, like the question was specifically about Ergo, because the things with tailings are they're at surface. There's a finite amount at surface. There's no kind of upside in terms of what you may discover underground. You know what's sitting there. You know how long it will take to work your way through that. And with Ergo, the grade lowering, you're going to need to put more ore through, and therefore it's going to be more expensive for you. So I appreciate you talking about looking at things like the cost of energy, which is a big problem in South Africa. Cost of being rising for several years now, and the relationship with Eskom and several companies is well documented. But at some point you said this has got a longer life than the 8 years you indicated to me before if you spent enough money on it, right? And I know it's an ongoing process of evaluation. Is that something that you have got an answer for now?
Yes, no, what we are doing obviously is expanding the size of our tailings dam. We need to make sure that we have sufficient capacity in tailings deposition on our tailings deposition dam to continue to treat material at the rate that we need to treat it at in order to maintain production run rate. So a few years into the future compared to where we are now. So in order to maintain throughput rate, in order to make sure that you have the right sort of mix, the right combination of material to maintain a sustainable head grade, there's an ongoing process of opening up new recovery sites and systematic closing down those that are finished. And you go through different cycles. Not all tailings dams are of equal size. And also through different phases of complexity. And the more sites you have, the more complicated or more complex your model is, and the higher your costs. So at the moment, for example, we're treating material from around 7 sites. We have access to 7 sites where we're recovering material from. And that's probably as complicated as it's going to get. As complex rather as it's going to get. Over the next few years, the number of sites we will be recovering material from, in accordance with the mine plan, the near future mine plan, will reduce. So instead of mining from 7 sites, we'll be mining from, let's say, 4 sites. They will be higher in volume, but slightly lower in grade. And that's where the offset comes in. So less complexity, fewer sites, which means your per ton costs drop. But then obviously because the grades are slightly lower, your revenue per ton would also adjust. And on the whole, that pretty much gives you I wouldn't call it a flat line, but that's how you maintain sustainability is through the combination of material, the mix of material, and the development of different sites to not have as many moving parts, so to speak. So 3 years from now, we'll have fewer moving parts, slightly lower recovery per ton, but fewer moving parts, which also imply lower cost per ton.
Okay, no, which I understand. So that's you, as you say, when you're putting through 2.5 million tons per annum, each ton is really important. If you just shaving costs or saving costs or reducing the amount that it's going to cost you going forward, it's all important. It's the nuanced detail of the engineering and the flow sheets and so forth. I get that. The other big part of this is building up a forward pipeline of deals, projects, and ores that you can process. Now, Sibanye is a 50% shareholder. They're obviously delighted with that relationship, given what you've done this year. They've also sitting on a lot of other projects that you can do. We talked previously about Far West. How are things going there? How the numbers seem to be good, but anything we should be aware of?
Yes, no, absolutely. So as I say, I mean, Ergo's project pipeline is pretty much paved out, and the new sites that are going to be developed. At the Far West operation, I mean, we started out with phase one only initially in order to get into production sooner rather than later. But phase one is um, uh, it's sustainable in its own right, but you couldn't really go beyond 12 years of production mining only off our existing infrastructure. So we're keen to get into the second phase, which is the upgrading of volume throughput to just north of 1 million tons. And that also implies a larger tailings deposition facility. And that was part of what we'd envisaged when we did the transaction. Early phase, lower volume, higher grade production. In the longer term, to get it to 18 to 23 years, the second phase with a bigger plant and a bigger deposition facility. Provided obviously that the investment climate remains positive. I think the part that I find exciting about the Sibanye relationship are those bits which are probably that weren't part of the short-term planning, the immediate planning when we did the transaction, but which are now emerging as this relationship is developing. There's still a lot of assets within the Sibanye portfolio that are not core assets in terms of the Sibanye strategy. Their strategy in terms of mining obviously is more focused on virgin ground, double underground, in terms of the gold mines. Nobody buys a Sibanye Stillwater share because they have hundreds of millions of tons of tailings material. And I think increasingly we could identify some of those and bring about a larger scale consolidation of surface tailings and feed into those. Also, and this is something that I think is definitely going to start picking up a bit of momentum, is venturing into other metals. They are one of the largest platinum producers in the world. And this is certainly something that at this point remains untapped, as how assets that which are there, which are perfectly suitable for surface processing, is not given the sort of recognition that putting it in a bespoke brand that is associated with the recycling of tailings, environmental cleanup, the kind of market premium that is attributed to that. And that is definitely a conversation that we would want to accelerate now that we have a little bit more freedom of movement.
Okay. So for people who don't know, Sibanye is a huge organisation. I say lots of tailings at surface, not just gold. We've got the platinum group metals as well. But how does it work? They're 50% shareholder in you, but each deal's different. Okay, so they're not going to stick with the same deal that you just done on Far West. They're going to look at the market. They're going to look at how much money you're making and structure a new type of deal, aren't they?
Well, remember because they're an interested party, because they have a large stake in gold, every transaction comes with a very significant scrutiny. It has to be independently verified, etc., etc. So Sibanye is being mindful of how important good governance is in maintaining the credibility of the structure. So the rules of governance are very, very closely followed because their stake in DRDGOLD is worth what the other investors say it's worth. They don't trade their shares. It's the rest of the market that trades their shares. And if the market gets the sense that there is undue interference or sort of funny business, that's going to find its way into the valuation of the stock. So the transactions are looked at obviously with due regard to what potential value they may have, but there is very significant independent scrutiny of everything that we want to do. In terms of platinum, I do believe that that environment's different compared to gold. So gold you produce, you take full exposure to the gold price, you sell it at spot, it goes through metals exchange, bullion banks, etc., etc. It's not a particularly complex trading environment. Platinum and the PGM metals, I think, that's a completely different scenario. There you have direct relations with your clients. There are offtake agreements. There's chrome, there's rhodium, there's palladium. There are different users, consumers, and buyers of these metals, which which is far more complicated. It's not something that we have a lot of experience with. So I think in looking at these transactions, one would take a very close look at exactly what it is that we will do in the value chain. What is it that we will produce? Is it going to be a concentrate? Is it going to be a final product? Are we going to be selling to Sibanye Stillwater, or are we going to be selling to the end client, etc., etc.? And along those lines, I think we will be able to model these transactions, and they're capable of being modeled. It means that you probably not see the same kind of potential multiple that we saw with the Far West Gold transaction, because of those funds carrying a minus 600 million rand negative value in terms of rehabilitation, closure costs, etc., wasn't within the context of the structured existing series of relationships or system of trading. Whereas the platinum is completely different. I think there are existing arrangements, existing clients, etc., and somehow we need to find a way of fitting into this larger process to add additional value to an existing platform, so to speak. And it's going to be easier to model, I believe. I think it'll be quite simple to scrutinize those from a governance perspective, but maybe not quite as powerful a multiple or dynamic a multiple in terms of the market cap. That's sort of my early take on it. The market might take a completely different view. They might say, hey, hang on a second, this is now a multiple commodity, diversification of risk, different economic cycles. This is actually really starting to pick up a bit of momentum. So maybe there's a what's called a growth dividend. I believe that's also an accepted term in investment.
It is. It's what we live for. Yeah, it's what we live for. Yeah. Let me try and understand the relationship, because 50% shareholder who are not trading your shares, they're sitting on paper, not doing anything with it. I'm intrigued as to how they see themselves making money. Is they're not living for the dividend. That's clearly, that's not going to change their balance sheet. But the relationship at the beginning, they were more important to you than you were to them, right? But with the market changing and the success of what you've been doing because of your process-driven ability to deliver good returns, they're looking at this and going, well, they know what they're doing, so we like them from that perspective. But they can have conversations with your competitors about any of these assets going forward. So as much as you want to kind of capture all of their ore at surface in South Africa, in Joburg and elsewhere, how do you ensure that you can secure that line of forward-looking revenue from them? What are you going to say to them to say, look, we're obviously the best partner for you?
The first phase of Far West was very important for exactly that reason, because the point you make is 100% correct. They're not obliged to give us anything. Sibanye can go and do a transaction with whomever they please, and we're not the only kid on the block. There are other players as well. So to deliver into the expectations that we created around Far West Gold, the first phase was very important to us. Project credibility. We wanted to establish project credibility, ability to deliver into the expectations that we created. In terms of the greater value composite, I do believe that if you look at the Sibanye website and how they present themselves, the key value is how mining improves lives. If you look at the social investment mantra that we developed over time is we want to enhance the quality of life of those who live in proximity of our operations. So there was alignment even before there was a relationship. And I think that alignment of values, and I think and I see in how Sibanye presents DRDGOLD as part of its greater group, there's a lot of focus on the ESG aspect of our operations. The fact that rehabilitation through mining is such an important part of our brand identity. there's a consistency there in values which they present. So I don't quite know how Sibanye sees us in terms of how important the economic success of the company is as a main sort of priority for them. But what I do know is that the things that we do in terms of sustainability and environmental cleanup, in finding solutions for the social impacts of mining, and in mining in such a way that it's increasingly energy friendly, whilst also being water wise, making sure that the impact of mining, our operations, that those are contained, the environmental impacts, and that they don't impact on surrounding communities, etc., etc. Those are incredibly important values within the Sibanye group, Sibanye-Stillwater group. And I think the fact that there is now a company, a group member, that as core to its strategy, that it lives those values, and that those values are as important as the commercial success of the business. The commercial success is more of a consequence of the very deliberate pursuit of many of those value components. I think that is an important feature of that relationship.
Okay, but I think most tailings companies would say remediation is part of what they do, and if it remediates the land, that it can be used for other uses. It's all good, and the ESG component is very strong. So what I'm trying to work out is is that unique to you, or is that something that have the conversations happened already, which say, look, you're the one for us moving forward, or those deals still to be negotiated?
I'm not sure if there's anybody else who's had this as core to their strategic thinking. If you were to go back into our integrated goals over the last decade, for that matter, sustainable development as a core feature of our strategic thinking of how it informed the deployment of resources and capital. I do not know if there's been that consistency in approach and strategy. It is embedded in the DNA of our company. It's not to say that we have it 100% down, and that there aren't issues that still need to be built. We're sitting on a footprint that is 100 years old. It's going to take time, but I think you can't fake your way through sustainable development. The moment you start treating it as though it's marketing and not a core value, not a genuine pursuit, sorry, you're going to be caught out.
Yeah,
it's hard enough as it is. I know the hearts and the minds of my colleagues. I know how important these things are, and we still come under criticism. We still blame for doing this, that, and the following. So if it's superficial, if it's artificial, I'm sorry, you're not going to get anywhere. And hopefully, I think Sibanye may have spotted that there's integrity in that mantra, that there's integrity in that strategy, that there's a genuine pursuit of those values. And I think it resonates with them. I think they believe those things, and they want to be invested in the company that it's set course on achieving those outcomes.
So coming back to Sibanye, so they're 50% shareholder at the moment. Do you think there's an argument which says, look, could you, because I'm looking at your ESG component here. There's a lot of new ESG funds opening up in London, New York, everywhere. I mean, it's trebled, quadrupled in the last 2-3 years, and they are, some of them more meaningful than others, obviously, and some of them a bit more serious about it and not sort of latching onto just a sort of marketing thematic. But do you think that Sibanye should actually give up some of their position to allow a few more shares to trade in the marketplace? Because despite having a good year, I mean, your volumes of trading could be better if there's a bit more, float out there, surely.
I think the market, the fact that Sibanye has a controlling stake in the company is something that the market likes it. A big part of the increase in our market cap, I think, has been as a consequence of that. Remember, Sibanye invested just more than R1 billion into the capital of our company, no strings attached in the beginning of the year. To take their stake to 50, there was no expectation of special dividends or anything like that. So as the money, we want to have a controlling stake in the company, and we will apply that towards the growth and expansion of our company. If they were to reduce below that, I think the market might wonder why. Why is Sibanye allowing its position to be diluted? If you were to listen to a presentation, any presentation by the Sibanye-Stillwater executive on where they're going to go, it reminded me of the early days of Rand Gold. When you had these phases, and this is what we're going to do, and this is the next thing. There's an energy, and I think the market likes that energy. And if you're associated with that energy, notwithstanding the fact that we're ESG and sustainable development, it's a core value. There's an excitement about what's going to happen next. So to be associated with that, this expectation of growth, innovation, something new, I think it's very valuable. And I think it's finding its way also in the way that our stock is being viewed by the market. You'd be silly not to leverage that. You'd be silly not to share that with whomever's prepared to listen. Sibanye is doing things, and we're right there. We're in that slipstream, and wherever they go, we're going to be going with them.
So you think the market thinks that you're the takeout target for Sibanye at some point? Is that what they're reading into it?
No, I don't think so. I think they see us as sort of as right there in the slipstream, that as Sibanye grows, new opportunities for us to also grow and spread our wings and find new exciting things to do. We'll be right there.
Okay. Yeah, I think we've run out of time. I could talk about this all day. I think it's a fantastic company. You've done some great things in the last couple of years. Keep doing them. We'll speak to you soon.
No, thank you. Thanks very much for the opportunity, and I enjoyed this conversation. Thank you.